Diop. I'm the head of membership at Bayer in the Health Cluster of Wallonia in Belgium. It's a pleasure to welcome you today for this second webinar about the US medtech industry in the framework of the MAGIA2Market project. 2 weeks ago, we gave you an overview of the current medtech trends in the United States. And thanks to our partner Medical Alley, based in Minneapolis, you receive, I guess, precious and valuable information to feed your US strategy. Today, we'll explore another very important topic and probably one of the most decisive for you, your ability to connect to US venture capitalists. We know that more and more European medtech companies are looking to connect to US investors. However, the most common face challenge is that all companies are not venture capital fundable. Thus, what does a US venture capitalist look at? That's the topic we will explore today. Our two guests are again Eugenio Mimosi, coordinator of the MAGIA2Market project. He will give you some insight about the project and information about where we are heading to, and maybe the things you can request from us in terms of support. And our specialist of today will be again Frank Jaskulki, Vice President of Medical Intelligence, and he will be the expert of today. At the end of the session, we will have the opportunity to raise and to ask questions, so feel free to comment on the chat. I will push the questions. So I hope you will enjoy the session and see you in a couple of minutes. Thank you.
So good morning, everyone. I'm Eugenio Mimosi from BioPMed. I'm going to give you a very short overview of the project, MAGIA2Market, which is the project that is bringing you today this webinar. MAGIA is an alliance of 4 European life science clusters based in 4 European countries, in Belgium, Germany, France, and Italy. We represent a community of about 2,000 companies operating in the healthcare sector, and a community of over 50 university research centers, academia, and hospitals. And our alliance was born in 2018 to support small and medium-sized European companies operating in medtech to establish contact and network in countries outside of Europe, specifically in the United States of America, in China, and in Japan. Over the years, we have produced a series of materials to help small companies getting a first idea of these 3 difficult markets that are very hard to understand sometimes. On our website that you can find at www.magia2market.com or following the link that you find in the slides that we will share with you after the webinar. You will find 3 professional market reports about these 3 markets, which will cover some topics that you will find interesting if you want to enter in these 3 markets concerning the market access and regulatory affairs. You will also find on the MAGIA2Market website a series of training videos about United States and China, again covering the topics of market access and product liability and the regulatory path that you will have to face when you will enter in these 2 markets with your products. Also, as I said in the beginning, our main goal is to help European companies get in touch with counterparts in outside of Europe and to establish contacts and hopefully collaborative projects. So if you have some needs in terms of networking in these 3 markets, feel free to get in touch with your local MAGIA clusters in your region and reach out to us with your needs, and we will be happy to assist you and also with the help of our partners in these three markets, which as you will see very soon, one of them is Medical Alley in the United States, and Frank Jaskolki, which I will give the floor very soon, is the representative for the American cluster. So feel free to reach out to us and visit the website. And I hope you will enjoy this webinar for today. Feel free to ask questions, and later on, at the end of the webinar, we will forward them to Frank, which I'm sure will be happy to answer to them. So thanks again, and Frank, now I will give you the floor. Let's see.
Thank you. Yeah, I'll get my presentation up. Good afternoon, everyone.
Just a sec.
Good morning from Minneapolis.
Okay.
Here we go. Perfect. All right. Well, it's a pleasure to be with you my morning, your afternoon today, and talk a little bit about what's maybe the most common question that I get, which is, oops, did I just lose the presentation? I'm sorry, it just...
No, we can see it. We can see it.
We see it.
It's fine.
Okay, well, hang on. I can't see it. That was weird.
Perfect.
Sorry about that. But it's probably the most common question that I get from companies domestically and internationally on what makes a venture fundable company. So I'm going to go through a presentation based on conversations we've had with dozens of venture capital firms on what they look for in order to fund a company. And please, as I'm going through this, I've got the chat window up. If you have any questions, you want to throw them in there. Otherwise, I will be available after the presentation. I'm coming to you from Medical Alley from the state of Minnesota in the center of the United States. We have one of the largest healthcare technology clusters in the world with Mayo, Medtronic, United Health Group, and hundreds of small companies. Our work is very simple. We want to see more healthcare and health innovation companies get going. While we're focused on Minnesota, the industry is global, and so we depend on interacting and an influx of global companies that bring technology, talent, and capital to the region and to the United States. I'm sorry about that. I don't know why it keeps switching to my camera instead of staying on the presentation. My apologies. I'm just going to turn off my camera and leave on there we go. Sorry about that. As an organization, we represent a number of brands that you might recognize, like Philips, Medtronic, Abbott 3M, and many others. This gives us a depth of talent and expertise we can draw on to support your work when you come to enter the US market. In total, it's about 15,000 healthcare companies that employ about 500,000 people in the state. That's enough about where I'm from. What's more important is what you're looking to accomplish, which potentially is to raise money from venture capitalists. And so we went out and talked to a number of venture capitalists and asked them, what is it that they look for? It's the single most common question that we get from people like you, and it's the most common challenge that we encounter. What I want to say, though, is that nothing I'm about to present is 100% definitive. There are always exceptions. These should be considered general guidelines and what most venture capitalists look at, but not all. The most important thing to recognize in your work is that not all companies are venture fundable. As a category of financing, venture capital is about 1% of all capital that is deployed in the US. The venture capitalists we talk to tell us, and this is consistent across the board, that for every investment they make, they've reviewed 300 to 1,000 companies. So it's easier to get into the top universities in the world than it is to raise venture capital. Your company needs a financing strategy, but you need to figure out if that financing strategy is venture capital or if it's something else. The first question that any company that's looking to raise venture capital needs to answer is, can you give up control? Once you take capital from a venture capitalist, you are selling a portion of the company. And if you're a venture backable firm, it is highly likely that by the time you reach some sort of growth point, you will lose majority control of the company. That will mean you will be working for the investors, and they will have the final say in key strategic decisions, hiring and firing of the executives, and whether or not and how the company is exited. For trade-off, you gain capital that can allow you to grow faster, and having a smaller percentage of a fast-growing business can be much more valuable than having a large percentage of a not growing business. But if you're not willing to give up control, then you should stop right away and not pursue venture capital. The second thing that they're going to look at is the market size. Are you building a business that is venture backable? Generally, what they look for is a company that has a $1 billion plus total addressable market. It's a company that's going to be able to generate significant revenue, capture a significant portion of the market, and is in a big enough market where the investment they put into your company will generate an exit that will return their capital many times over. The next thing they're going to ask about is your competition. They're going to want to know what is being done today, who might compete with you in the future, and are there barriers to those companies entering the market? A very important thing here is if you get asked the question and your answer is, I have no competitors, you should expect that the venture capitalist might end the meeting right there, or if they don't, they're highly unlikely to make an investment. It is an immediate red flag that you don't know your market, you don't know your business, because even if there actually are no direct competitors, the competitor then is just not changing behavior, doing what is already done today, which while it may be inferior or it may not treat the condition, it is the current state of affairs and you have to change it. Next thing they're going to look at, particularly if you're in a regulated market, is your clinical, regulatory, and reimbursement strategy. And this increasingly can apply to digital products. They're independently important to your clinical strategy, your reg strategy, your reimbursement strategy, but they also are quite interdependent on each other. What you do for clinical studies is going to affect how and when you get regulatory approval and what sort of reimbursement you might get. The regulatory pathway that you want to pursue will influence your clinical studies, and it also may lock you into a reimbursement approach that is good or not good for your business. You should be able to clearly lay out what you're going to do, why you're going to do it, how long you'd expect it to take, and how much it might cost. And particularly, you should be able to demonstrate that the clinical data you're going to collect is sufficiently strong to drive adoption and drive payment. We see a lot of companies that they want to pursue, say, a 510K strategy with limited clinical evidence because it's quick to market. It's quick to FDA clearance. You can legally sell, but it may not be quick to getting reimbursement at a sufficient level to have a profitable business, or have enough evidence to cause clinicians to change their behavior and use your product or service. On the digital health side, where it gets a little bit different, is that they'll want to see that there's a real clinical need and that you have a repeatable sales model. So whereas in the device world, it's very common for early stage investment to be pre-revenue, in the digital world, it is much less common. Early stage investments may already have some revenue, may have significant revenue. And what the investors are going to want to know is A, is there a real clinical need and do you have proof? They've seen 100 wellness companies. They've seen 100 musculoskeletal companies. They've seen 100 diabetes companies. Why is yours better than the 99 other ones they've already seen? And then selling digital products in the US is a very long sales cycle. It can be 6, 9, 12, 18 months per customer. The investors want to know that you've proven you can find, acquire, and retain customers before they might make an investment. Next thing that they'll look at, particularly if it's in the device world, is the technology and the manufacturing that's needed for it. What is the cost to manufacture the product fully loaded, especially today where logistics costs are really being borne out? If you need to bring components in from another country, can you do that? Do you have second sources? And can you do it at a cost that leaves you sufficient margin to cover sales and marketing, reimbursement, clinical studies, and still have a profit? And then the next thing is they'll want to know, is it sufficiently differentiated? Is it unique where you can get real intellectual property? We see a lot of companies where they're doing a thing differently than is what is done today, but it's not different in a way that actually matters, that creates value. So can you show that your product is not just different, but it's differentiated? It has a unique advantage over the current state of the market. Then they'll want to know about your strategy. If they give you that money, if they put $10 million into your company, what will you do with it? What value will it create? You're going to have a set of milestones, and those milestones should lead to they would say, a step up in the valuation of the company, such that if they invested and your company was worth 10 million when they wrote the check, after 2 years of work, is your company going to be worth 50 million, 100 million? How are you going to do that, and why are you going to do that? And maybe most importantly within all of the strategy is your ability to execute on it. How do you prove to them, how do you demonstrate to the investors that not only is your strategy the right one to pursue, but that you as a leader and your team are capable of executing it better than anyone else? And in fact, that will be maybe the most important thing they look at. If they believe you have a big market, a differentiated technology, and a strategy to attack it, they'll want to know, is your team the type that can create venture level value? Can you take that strategy, take that capital, execute on it, and build the company into something very significant? Do you have board members that are aligned to that strategy? Are your other investors aligned to it? And maybe the most important thing that's underappreciated is, will you be willing to make changes in your team as the company develops? The founding CEO may not be the right person to take the company from $1 million in revenue to $100 million in revenue. That CTO or head of R&D that you started with may not be the right person to work in the company when you're taking the product from a prototype to something that's manufacturable at scale. Are you willing to fire yourself if it is in the best interest of the company? And go back to that very first slide of giving up control. When you take the investments, you're implicitly giving another person decision-making authority in your company. You may retain the majority control, but if at a later point you need more capital from them, you may technically be in control, but they may really or actually be in control. Then they'll dig into your financials. What resources do you already have, and have you used them well? One advantage that I see many European companies have over US companies is you have a bigger group of public financing resources. In the US, there really aren't grant resources. that can be used to fund R&D or commercial activity to the same degree as what you find in the European Union? Have you secured those resources, and have you used them in a way that creates real value? And here's a mistake that I often see. We see resources come in that are used in R&D, and companies spread it out very thinly and develop a lot of applications for their product, but they're all at a very early stage. Instead of taking one application, getting it through preclinical, and getting initial human data, creating value in that asset such that you've taken the risk for the venture capitalist down. If you do that, if you say, hey, we can do 20 things with this, we've picked this one because it's a big market and we can execute on it, and we've used non-dilutive financing to advance it, you will have a much higher probability of securing investment. Next thing that they'll look at is if your cap table or your capitalization table is clean. That is to say, do they look at your investors and see 50 different individuals who have different terms, different safe notes, different discounts, a whole bunch of things that are very messy, make it complicated, might mean a lot of people that they're going to have to work with in order to advance the business? Or is it clean with only a couple of investors who have similar terms and can be organized as a group and worked with, and that are professionals? And are your projects that you're investing in, the way you've been spending your capital, can you demonstrate how they've advanced value, why you're doing them, and why they've set you up to be ready to raise venture capital? Lastly, what they'll end up considering is exit considerations. You have to remember that venture capitalists are a financial investor. They want to see a return. Generally, they want to see a 10x return. So if they put 10 million in, they want 100 million out. Have you thought about how you will exit? You should be thinking about this at the various earliest stages of the company. Trade sales are the most common, followed by IPO. If your intent is to build a large company where you won't sell or you won't go public, you might need to rethink your strategy for raising capital. It may not be suited for venture capitalists. If you are going to pursue an M&A strategy, who are the logical buyers? Do you know them? Have you built relationships with them? Do you know they want what you're building? You can have those conversations pretty darn early. Do you know what the buyers would need to give you a fair price? You got to remember, at the end of the day, if someone is going to buy your company, they have a set of values, they have a set of needs. Are you building your company for their needs, or are you building the company for the things you think are important? I promise you, what you think is important and what they think is important is not the same thing. Have you researched historical comparables to know that the market you're in generally has exits large enough to attract venture capitalists? Are you in a big enough market where you have a business that could go public? If you can do that, you have another pathway to exit, so long as what you could exit at going public is high enough to generate the return for the investors. When you make an investment with, or when you take an investment from a venture capitalist, they're going to structure a deal that's going to have a whole range of legal terms in it and a whole range of requirements that can bind you into going a certain direction. Make sure you understand those terms. They vary by country, they vary by investor type, and you should early on get a great lawyer. They will be expensive and they will be worth every penny you pay for them to make sure that you understand what you're signing up for, that you negotiate effectively, and that you get terms that protect your rights as a founder or as an entrepreneur, so that you don't inadvertently give away things you're not comfortable with. Go back to the very start. Are you comfortable giving up control? If you are, then proceed with venture capitalists, but still invest in the legal help to make sure you get the right terms and the protections for yourself and for your company. And with that, I'll stop chatting at you, go back to on camera, and just say thank you for listening to me and for your time today. If you have any questions, please do let me know, and I'll be happy to share the slide deck afterwards. And if anyone wants to reach out after the session, our friends here at MAGIA will send you my contact information. I'm always happy to have a conversation. Thank you.
Thank you, Frank, for all this valuable information and insight based on your own experience. I have a question here from someone who wrote me in the chat. He said that for the portfolio management, European VC tends to make a clear distinction between diagnostic and therapeutic technology. And to your opinion, do you feel the same approach in the US market?
Very much so. You know, historically, diagnostic companies had much lower value than therapeutic companies. It just was, you know, the price you could get for the products, the size of the markets, etc. That is changing to some degree, but it is still generally true that therapy has greater financial value than diagnostics. The other part of it is diagnostics is a really crowded market. And so we see just a ton of companies, investors see a ton of companies that are relatively undifferentiated. You know, like right now, everyone is making a point of care rapid diagnostic that's going after infectious disease. Unless you're doing something that is truly clinically breakthrough, they've probably seen it before. Diagnostics are a much harder space to get venture funded. Not impossible, but harder.
Okay, thank you. Are there other questions from the audience? Don't be shy.
It's always a challenging topic. You know, and we didn't talk about other forms of financing. That's probably a thing for another day, but I wanted to make sure that you all had a sense of, for that narrow slice of venture capital, what you're signing up for.
Yes. Okay, there are no more questions for the audience. One of my colleagues is asking to raise a question. Olivier, yes, feel free to write in the chat. Olivier? He cannot find the chat. Wait, hold on. Or write to me directly. I will push the questions.
No worries.
Okay, he is writing for a moment.
You all are getting to watch the sunrise right behind me.
It's still raining here.
I think, meanwhile, we have a question from Sarah, which, well, a series of questions. She's asking, can you comment on the value of clinical evidence? Is 510K with clinical evidence also a good option? Since you mentioned that 510K is not always the best option, and it seems that most of the US venture capital funds are asking startups to be present in the US. Are they also willing to invest in the EU-based startups?
Good questions. So on the 510K with clinical evidence, 510Ks have fallen somewhat out of favor from the venture capital community. The primary reason being it's harder to get a large market with a 510K product. When you do a 510K, you're explicitly saying, I'm copying something that's already out there. It's substantially equivalent. In that environment, it's hard to truly make something that is better in a big, giant market. Not impossible, it's just another layer. Clinical evidence is incredibly important because it's what's going to give you the ability to differentiate your product in the market. So if you don't do clinical studies, you're basically saying we're just making a carbon copy. So if your price isn't lower, how are you competitive? How are you actually better? Where's your proof? If you have good clinical evidence that shows superior outcomes and better cost profile, you can use that to drive adoption, and that can build a big market, but you might need to get further along in development to raise the money before you can raise the venture capital. What it mostly comes down to, though, is the size of the market that you're going into and how competitive you can be in it. When you do a PMA, generally you have more market protection, a larger market because it's a significant clinical issue, but there's always exceptions. On the EU versus US side, there are a growing number of funds that will invest in EU-based companies before they're in the US. Generally, those have fallen into the PMA category for the US regulatory schema. If you were doing a 510K company and you were only in Europe, probably not a big enough market to get a venture capitalist, but there's always exceptions. What they would want to see on the US side is that you have a pathway to develop the US market. While you can build a very large business in Europe, the US market is, the size of Europe plus the rest of the world. And so your odds of building a venture scale company are higher. Question in the chat on the inertia of US doctors with new med tech. Is it difficult to change their way of thinking? It's difficult to change any person's way of thinking, and that's where evidence comes in. So if you have a new medical product and you're going to bring it to market, and let's say it's in cardiology, the doctor probably has something they're doing today. It may be medication, it may be a surgical option, it may just be advising the patient to do watchful waiting. When you bring a new product in, you have to get the doctor, the nurses, the hospital administrators to change what they were doing to what you want them to do. That always is harder, takes longer, and costs more than companies plan for. I promise you, the idea you have does not seem as exciting to the docs as you think it is. Think about their world. They're working long hours. They're dealing with people who are sick and unhealthy. It's a high stress environment. And then you come in and you say, hey, take that routine you already have that you're used to doing and now change it. Think about if you have to learn a new language. It's really, really, really hard at first. You got to do a ton of work up front. It eventually becomes easier as you practice it more and more. That's what you're having them do, learn a new language. But get this, you're not the only one. There might be 20 other companies going to that same doctor and asking them to change a different part of their practice. So imagine if you were trying to learn 20 languages at once while still doing your day job. That's what they're going through every day when all of us come to them with our new innovations. So if we're going to get them to change, we have to give them a really good reason to want to change.
And
any other question?
Yes, there is one other question. Do you think that venture capital funds is a good option for well-established, perhaps family-owned SMEs in comparison to startups that are still in the process of creating structures? Regarding the giving up of the decision-making power, do you have some experience with that?
Great question. So an established family-owned company could be, it might be more like, technically venture capital is private equity, but there's a distinction. A family-owned company may find a private equity investor more aligned to where they're going. What a venture capital firm ultimately wants to see is a business that has rapid growth potential. So if you were a 100-year-old family-owned company that has had steady growth and good profit, may not be venture capital aligned. If you're now entering a new market and you expect, we're going to grow like a rocket ship, it could be, but it may be more appropriate to look at a private equity fund that invests in established businesses. It's kind of the same setup, it's just a different asset class. So venture capital tends to invest in new businesses. Private equity tends to invest in established businesses. I'm sorry, say the second part of the question again. Oh, the experience with giving up control. So I haven't had to do that myself, but many of our members have, and that's who we talk to about these. And I've seen it go really well. Companies know what they're getting into, they plan for it, they execute, they have an exit, and they may only own 5% of the company, but the company went from being worth 10 million to a couple billion. And I've seen it go bad where founders give up control, don't execute, or have bad terms with their investors and are fired by the board. The board brings in new management and the founder gets nothing. I've also seen it go bad where the founders bring in some investors, but they retain control, poorly manage the company, and then destroy value and cause the investors to lose a lot of money. So it ultimately comes down to running a good business, which really means making decisions in the best interest of the business and not of yourself.
And maybe one last question. If someone is asking, does a European company need to have a local office in the US to convince the VC and doctor? So I think, to your opinion, is it mandatory to establish a local office in the US?
Right. So they're two separate things, the VC and the doctor. For the VC, there are some US VCs who will invest in non-US companies. It's increasingly common, but it's not common. And all the usual things would apply. The company would have to be venture backable, but there would be an additional layer that they have lots and lots of opportunities in the US. So if they're going to invest in a company that might be multiple time zones away, a long flight away, hard to interact with and manage, they're going to need to see an asset that is significantly better than what they might look at if it was US based. On the commercial side, on the convincing the doctors, you don't necessarily have to have a US office, but you do have to have a US presence. You are not going to convince the doctors remotely. They probably won't take you very seriously. That doesn't mean you go get a big office and you hire 30 people, but it does mean there probably needs to be some US representation, and not just a distributor. If you're in a very simple product, one that's in an established market and you've made it a bit better, the distributor pathway could be good. If you're bringing a truly new, differentiated product that's going to require education, no one is going to have as much motivation as an employee to bring that product forward.
Okay, thank you.
And I will say, just a general statement, overarching challenge I see in US companies and in European companies coming into the US market is they try to go cheap. If you're truly trying to build a large business, it is going to cost a significant amount of money. And if you're not prepared to make that large investment, you're probably better off not taking the leap, because if you spend just a little bit of money, you really don't get anywhere and the money just is wasted. Like, either commit or don't, but don't be halfway.
Okay. No more questions from the audience? If no, I would propose to end the session. So as mentioned by Frank, do not hesitate to reach out directly for question. With a more focus on your own activities. We will be very happy to give you any clue about that. So I wish you all a very good day, and to you, Frank, thank you again.
Thank you
great, for your, especially the feedback from the field you gave. It's always interesting to have this kind of information.
Oh, pleasure. It's always good to spend it with you all. Have a good one.
You too. I wish you all a very good day and see you. Bye bye.
Thank you. Bye bye.
Bye bye. Bye bye.